Good afternoon, everybody. We're going to get started in just a minute or two. So if you can just sit tight, relax, go and get yourself a water or a coffee, and we'll be starting soon. Okay, it's 2 minutes past 2 here in Sydney. I think it's time that we can make a start. Good afternoon, everybody. And for those of you in Western Australia, good morning and welcome, ladies, gentlemen, trustees, accountants, financial planners, and all lovers of ECPI. Just some housekeeping to start off. If you have any questions as we go through the webinar, just feel free to pop those in the Q&A box. I'll be stopping from time to time to look at the questions and answer them. And there'll be plenty of time for questions at the end. I'll be staying on until the end of the webinar in order to answer any questions that there are, even if we go a little bit over time. My name is Greg Einfeld. As you can see on the slide, I am the founder and the actuary at Lime Actuarial, and I'll be your presenter today. I'll be sending a recording of the webinar. It might take me a bit of time just in order to prepare and distribute that recording. So please be patient, and I do commit to have that out by the end of next week. So give me about a week or so. We've had over 500 registrations today, and so I'm really, really pleased. Clearly, there's plenty of interest in the topic, which is great. Most of the 500 are our clients. So to those of you that are clients and regular users of Lime Actuarial, thank you very much for your support, for your ongoing support, which, as you know, I really appreciate. And for those of you that are not clients yet, we look forward to hopefully working with you soon. So the topic today, in which there is great interest, is maximising ECPI in SMSFs. And it doesn't surprise me that there's strong interest in this topic, because ECPI is a really, really important component of SMSFs. And if you look across the entire superannuation industry, it's a big number. And we're going to start off today with a poll. We won't be doing lots of polls. We'll be doing two. And our first one is going to kick us off. And the question is, hopefully you can all see the question, what's the total annual ECPI across all of the superannuation industry? So I'm going to give you a little bit of time to respond to that. We'll probably go for about another 10 seconds and then I'll share the results. We've got a good spread so far, anywhere from 10 to $50 billion. Okay, let's wrap it up there. I'll share the results. Hopefully you can all see those results. It's pretty even distribution, almost a normal distribution, as any actuary would call it. Bell curve, slight skew to the upside, to the 30, 40 billion mark. So what's the correct answer? Well, there are no published statistics on this topic as far as I'm aware, but there were published statistics about 6 or 7 years ago. And at the time, the published number was around $19 billion. And I did my own back of the envelope calculations independently of that, and I came up with $30 billion. So if it was $19 billion 6 or 7 years ago, it's probably about $30 billion today, and that's consistent with my back of the envelope calculation. So I think that's what we'll run with. But whether it's 20 or 30 or 40, for anybody that said 30, give yourself a rap. But whether it's 20 or whether it's 30 or whether it's 40, I think the reality is it's a really big number and it's worth paying attention to. And our objective today is to make it an even bigger number so that if I run this webinar again in another 6 years' time, hopefully you'll all be using the techniques that we discussed today with your clients and we'll be able to get that number even higher. That's our objective for today. So thanks for responding to that poll and well done to everybody that got that one correct. Okay, let's move on to our next slide, which is our agenda. So what we're going to talk about today before the Q&A is 4 different topics. We're going to talk about choices that you can make and what you can do during a particular financial year in order to maximize ECPI. And we'll start off with some simple examples. Then we'll talk about the concept of deemed segregation, with which many of you will be familiar already. Then we'll look at choices you can make to maximize ECPI after the financial year has ended, taking deemed segregation into account. And then we're going to come back to choices you can make during the financial year, but in particular, looking at more complex examples. And then, as I said, there'll be plenty of time for Q&A at the end. So let's get into it. Now, this chart here, I'll explain it. So you've got plenty of time to get your head around it, but this is pretty typical of what we're going to look at today. We'll be focused more on concepts and pictures rather than lots of detailed calculations. In all of these charts, the lighter blue shades indicate accumulation, and there's a small color difference between the members, and the darker shades of blue indicate account-based pension. And we've got the balance on the y-axis and time on the x-axis. So hopefully you can get your head around what this chart is showing us. In this particular case, we have the first member who's called M1. The first member has his or her balance all in accumulation for the entire year, and the second member, called M2, just for something different, has his or her balance in accumulation for the first part of the year and then starts a pension, and the balance is in account-based pension for the second part of the year. So the member has decided to start this pension, and the question is, when is the best time of year in order to maximise ECPI? When should this member, M2, be starting the pension? I think you'll all know the answer to this question, and this is really just designed to warm you up. So assuming that the member has already met a condition of release, a full condition of release before the start of the year, so there's no restriction then on the timing, we have to make this choice as to moving that starting point to the right or to the left. So on this next slide, I'm showing you two different extreme options. And the option on the left is starting the pension right at the end of the year, so the balance stays in accumulation for the majority of the year. And the option on the right is starting the pension at the beginning of the year on the 1st of July, so the balance is in, member 2's balance is in account-based pension for the entire year. Now, before we talk about the difference, I should just point out that the ECPI calculation, if you're using the proportionate method, if we're calculating one percentage that applies across the entire year, we'll talk about the proportionate method in more detail. But if you're using the proportionate method, the ECPI calculation that you see on your actuarial certificate is the dark blue area divided by the total area. That's how actuaries calculate ECPI. We essentially, in the background, draw this diagram and we work out what's the area of the dark blue divided by the total area. So the example on the left, the dark blue is really small compared to the total area. If that's, let's say, 3 or 4 days, that's only 1% of the year that the balance is in pension, and that's just for member 2. So the ECPI is going to be less than 1%. And on the right, this member is in pension for the entire year, and the ECPI is going to be around 50% because M2's balance makes up around 50% of the fund and it's all in pension, versus M1, who is all in accumulation. So you can see there that M2 is going to be in a much better position in the second scenario on the right, because the dark blue makes up a larger proportion of the total. So what we take from this is that we should be starting the pension as early as possible in the year in order to increase our and maximize our ECI percentage. So that's the conclusion from this example, is we should start pensions early. Now, that's the case when there's no restriction of a condition of release. What if a member is to turn 65 or retire, having exceeded preservation age, during the year? I see a lot of accountants who say, oh, well, we'll wait until the 1st of July in order to start the pension. And while it might be convenient to wait till the 1st of July, you are missing out in that previous financial year. And so best practice is really to start that pension as soon as you can, on the 65th birthday or on the day of retirement, if that's before 65. And that will maximize your ECPI for people that are meeting that condition of release for the first time. You just want to start your pensions as soon as you possibly can in order to maximize ECPI. So there's our first example. In example 2, we're going to look at pension drawdowns and whether we should try and draw down early in the year or late in the year. So on the left, we have a scenario where M2 has drawn down earlier in the year. And you can see that the balance starts off higher. The dark blue starts off higher, and then it drops because the member has taken, let's say she's taken her pension drawdown reasonably early in the year, and then the balance remains pretty flat after that. Contrast that with the right-hand scenario where M2 has kept the pension balance as high as possible during the year and only drawn down at the end of the year. So I think you can see there, based on the shapes, you can see that the ECPI percentage is going to be higher on the right-hand side because we've got more balance in pension for longer. And the dark blue is a higher proportion of the overall area on the right-hand side compared with the left-hand side. This might be, in this particular example, close to 50% on the right versus maybe 30% on the left. So the message here is withdraw your pension balances as late as you possibly can in the year in order to maximize ECPI. Now we're going to come on to our third example, which is looking at contributions and the timing of contributions. And what I would like to do here is I would like to compare these two different scenarios and work out which one is going to give a better outcome. So have a look at the diagrams. The first one has the member, in this case, M1. M1 is making a contribution reasonably early in the year. And the second one is M1 making that contribution late in the year. And I'm going to ask the question, which is better? Which is going to deliver a better outcome? And I'm going to run another poll here. As I said, there'll be two polls today. This is the second one, second and final poll. Okay, so you should be able to see those results. And what's better, to contribute early in the year or to contribute late in the year? Okay, I'll leave this open for a few more seconds. Okay, I'm going to end the poll now. Share the results with you. So 75% of you have said contribute late in the financial year, and 25% have said contribute early. Now, I've seen three other actuaries, or I should say representatives of three other actuarial businesses, reasonably prominent actuarial businesses. I say representatives because not all of their representatives are actuaries. Representatives of other actuarial businesses who have presented and said that in this scenario, what you should be doing is contributing as late as possible in the financial year. And so 75% of you have agreed with those actuaries. And I'm sure the logic behind that is that the ECPI percentage that appears on your certificate is going to be higher when you contribute late in the financial year. It's higher because you're keeping the accumulation balance down. So the pension balance is a higher proportion of the total. Now, in my opinion, if all you're trying to do is maximize the ECPI percentage on your actuarial certificate, that is the right thing to do. That's not just an opinion, that's a fact. However, you can't spend ECPI percentage. It's a means to an end. And the way I look at this is to look more broadly at the member's overall financial position. Because if you're contributing late in the financial year, that money has to sit somewhere else throughout the financial year, and probably in your personal bank account or invested in your personal ownership, and you'll be paying tax on that outside superannuation at your marginal tax rate. Now, I would suggest that most people that are actively contributing to superannuation probably have a marginal tax rate of higher than 15%. So if it's a choice between having that sitting in your personal ownership, paying a marginal tax rate of maybe 30 or 37 or 45% plus Medicare, or having more money sitting in super where you're being taxed at maybe 15%, I'd rather have it sitting in super. So yes, by contributing early in the financial year, you will get a lower ECPI percentage. That's true. However, I think you'll be better off overall because you'd rather have that balance in super taxed at a lower rate than your marginal tax rate. So I have a different view there to the other actuaries, and that's just because I'm looking at this from a holistic financial perspective, not just the SMSF ECPI percentage on its own. So I hope that you can appreciate the distinction between those. So I'll stop sharing those results and we'll come back to the presentation. So as I said there, quite often you will be better off contributing early in the year. You get a lower ECPI percentage on your certificate, but probably a better overall financial outcome. That was a little bit of a trick question. So thank you to everybody that responded. And for those of you that did say contribute late, you're in good company because there's plenty of other representatives of actuarial businesses out there that would agree with you. So that finishes that section. We have had a couple of questions. So why don't we have a look at those? Okay, we have a question. Some funds that accumulated pension accounts more than one. They always converted the current accumulated become pension fund. Some other funds only have one accumulated pension. Which method do you suggest being good or better? So this is a question of whether you should have one pension account or multiple pension accounts. Because once you've started a pension, you can't add any more to that pension. So if you have more contributions and then you want to convert those into a pension, you need to start a second pension alongside the first pension. Now, some accountants have a practice of running multiple pensions in a fund, and certainly the accounting software enables you to do that, Class and BGL and Supermate, for example. Some accountants prefer to commute the first pension back to accumulation and then just have one larger pension. And I'm being asked which is a better outcome. So there is a little bit more administrative complexity to having multiple pensions, but it will give you a better tax outcome in certain situations, especially in relation to estate planning, because when you have one pension, you contaminate the different components, the different tax components, the tax-free and the taxable component. And when you have multiple pensions, you can keep those separate. And as you get into the drawdown phase, if you need to draw down more than your minimum required pension, then you can pick which one you draw down from. So yes, I do prefer to have multiple pensions. There are other benefits of multiple pensions as well. I don't want to go into it in too much detail because it doesn't relate directly to this topic of ECPI. But if anybody would like to go into this in more detail, feel free to send me an email after the session and I'm very happy to chat about it. Next question is from Daniel. In the first year, is it possible to calculate ECPI on the exact date instead of a percentage? For example, July 1 to Jan 10 is accumulation and Jan 11 income to June 30 income is pension mode. So Daniel, great question, which is a really good lead into the next section that we're about to discuss, which is deemed segregation. So can you please keep that question in mind as we go through this next section? Okay, next question. The pension account is $1.9 million. The member draws down $100,000. Can we draw $76,000 from the pension account, i.e. the minimum 4%, and $24,000 from the accumulation account? So a great question. I'm going to be addressing exactly this scenario later on in today's presentation in the last section with the more complex examples. So I'm glad you asked, but if you can hold on to that question as well, please, that would be great. Okay, so that answers the questions. I did also see that there's been one post in the Q&A in the webinar chat. Okay, that one is just an administrative comment. Okay, so let's move on now to the next section, deemed segregation. I'll try and move through this reasonably quickly because I have discussed this topic in a previous webinar, but I think it's a really good refresher as well. And some of you that missed that webinar or are newer to the industry will benefit from hearing this as well. So let's go through this section on deemed segregation. Assets are deemed to be segregated at a point in time if two conditions are met. And one of them is all of the member balances are in retirement pensions, such as account-based pensions or market-linked pensions. And secondly, the assets are not disregarded small fund assets. So if you meet those two criteria, then the assets are deemed to be segregated, which of course raises a question: what are disregarded small fund assets? I'm glad you asked because we have a definition here. So assets are considered to be disregarded small fund assets if two conditions are both met. And one of them is that a member, one or more members of the fund, had a total superannuation balance of more than $1.6 million at the previous 30th of June. Keep in mind that that TSB includes balances in other superannuation funds that member might belong to. And secondly, that same member had a retirement pension balance in a superannuation fund at that time, at the 30th of June. That second bullet point is often forgotten and overlooked. So if you have a member that meets both of those conditions, then the assets are considered to be disregarded small fund assets, and then that feeds into whether or not the assets are deemed to be segregated. Now, for all of the examples going forward, I'm going to assume that we don't have disregarded small fund assets. I'm going to assume that all the members, let's say, for example, have balances of less than $1.6 million, okay? So when we come to calculate ECPI, there are two different methods we can use. If the assets are segregated for the entire year, you must use the segregated method. In other words, you must calculate 100% ECPI for that fund for all periods where the assets are segregated, which in this case is for all of the year. So all of the income earned throughout the year will be 100% exempt. And in fact, if that's the case, you don't need an actuarial certificate. Okay, because the theory being anybody can work out that the ECPI is 100%. You don't need to be an actuary to work that out. In another scenario, if the assets are segregated for none of the year, so either if there are disregarded small fund assets or if there's an accumulation balance in the fund throughout the year, or perhaps a TRIS balance throughout the year, then you must use the proportionate method. You must calculate ECPI based on the average balances throughout the entire year. However, if the assets are segregated for part of the year, you have a choice. You can choose whether to use the proportionate method for all of the year or whether to use the segregated method when the assets are segregated and to use the proportionate method when the assets are unsegregated. So that probably all sounds a little bit theoretical. So why don't we look at an example? And this is coming into the question that was asked a few minutes ago around having a choice of different methods. So we have a scenario here where the balance of $1 million is in accumulation for the first half of the year and in account-based pension for the second half of the year. So the assets are unsegregated for the first half and segregated for the second half. And you have a choice here which method you use. You could use the proportionate method. And if you use the proportionate method, the actuary will calculate that the ECPI is 50% for the entire year. So any income that's earned, regardless of when in the year, 50% of that income will be exempt. And that's because 50% of the shaded area is in the dark blue. Alternatively, you could choose to use the segregated method. If you use the segregated method, any income earned in the first half of the year, the ECPI is going to be 0. And I call it the segregated method. It's really a hybrid of the segregated and the proportionate method. So you're using the proportionate method for the first half of the year. And the ECPI in that half is 0. That's what you'll see on your actuarial certificate. And you wouldn't need an actuarial certificate in this case because the actuarial certificate only applies to the unsegregated period. And during that period, there's no ECPI. So you don't need to spend $100 plus GST paying Lime Actuarial for an actuarial certificate that shows 0. You're better off just not getting an actuarial certificate in the first place. And for the second half of the year, any income earned is 100% exempt. As I said earlier, you don't need an actuary to tell you that income earned during that period is 100% exempt because the assets are segregated. The balance is all in pension. And if you're using accounting software, your software will do that calculation for you. Okay, so they're the two different methods you can use. We're going to drill down into this in more detail with some scenarios showing some numbers this time. So I'm going to take what I just explained, which was conceptual, and now put some numbers around it. And I'll come back to questions at the end of this next section because this is all interrelated. So I'm now taking the same scenario that I just showed you, and we're putting some income numbers in there. So in this case, we have $50,000 of income in the first half of the year and $50,000 of income in the second half. And so what we want to decide is, which method are we better off using? Are we better off using the proportionate method for the entire year, or are we better off using the proportionate method for the first part and the segregated method for the second part? So let's look at the calculations if we use the proportionate method for the entire year. So the calculation goes like this. There's $100,000 of income across the year. Our ECPI is 50%, and that's because the dark blue is 50% of the shaded area. So we'd pay 15% tax rate, but 50% of that is exempt. So effectively only 7.5% is going to be the tax rate on $100,000 of income. So we have tax of $7,500 if we use the proportionate method. Now let's compare that to the segregated method. In the first half of the year, we have $50,000. Now everything's in accumulation, so the exempt percentage you'll see on your actuarial certificate is 0. Everything's taxable, so we pay tax of 15% on $50,000, which is $7,500 of tax. Let's look at the second half. So in the second half, we also have income of $50,000, and it's 100% exempt because we're using the segregated method. We only look at the position in this second half when the assets are segregated. And because the income is all exempt, the tax is going to be 0. So if we add up the tax in the first half and the second half on the right-hand side, we have $7,500 of tax, which is identical to the tax under the proportionate method. In other words, when the income is evenly distributed across the year, when you've got consistent income, it's not going to make a difference mathematically which method you use. And it's going to come down to a personal preference. Now, in a previous webinar, I ran a poll asking which method accountants and financial planners find more intuitive. And the vast majority said they find the proportionate method more intuitive. And I also do. And for that reason, I would lean towards the proportionate method in this situation when it doesn't make a difference and when you have even income throughout the year. But that's a personal preference. The next example is the same, except this time we have all of the income being in the first half of the year. So if we do the proportionate method calculation, we have $100,000 of income, which is the same as what we had last time. And it's the same because we're calculating the income across the whole year. So this whole calculation is the same. 50% exempt again, because the dark blue makes up 50% of the total area. And when you perform the mathematics, you get $7,500 of tax once again. The segregated method, though, looks a bit different. In the first half, we have $100,000 of income. None of it is exempt because we're only looking at the first half of the year when the balances are all in accumulation. So the tax is 15%, of $100,000, which is $15,000. In the second half, we have no income. If there was income, it would all have been exempt, but there is no income and therefore there's no tax to pay. This time we'd be paying more tax under the segregated method, so we'd prefer to use the proportionate method. And in our third scenario, we have the reverse. Now we have all the income being back-ended. The proportionate method, once again, is exactly the same because we're looking across the entire year. $7,500 of tax. The segregated method, first half of the year, we've got no income and therefore no tax. And in the second half of the year, we have lots of income. We've got all our income in the second half, but it's all exempt because the assets are segregated. So the income's all exempt, so there's no tax. So in this scenario, by planning well and ensuring that the assets will be segregated in the second half of the year, when the income is earned, we're going to have no tax at all. It could be planning to make sure the assets are segregated when the income's earned. It could be planning to ensure that the income's earned when the assets are segregated. But whichever one it is, that's what we're trying to achieve. And so there is a lot of planning required here in order to achieve this particular outcome. So what's the preferred option? You're probably hoping that somebody is going to do this calculation for you and tell you what's better, the segregated method or the proportionate method. For those of you that use Class Super, unfortunately, Class is not going to recommend the preferred option to you. If you're using BGL, I'm sorry to say, you're going to be in the same boat. And I haven't mentioned Supermate here. We'll be integrating with Supermate, I think in the second half of 2025. If you're using Supermate, Supermate is also not going to tell you the preferred option. So you might think, well, maybe Lime Actuarial will tell me the preferred option, but I've got bad news for you there as well. Not only will Lime Actuarial not tell you the preferred option, but none of the actuaries that I'm aware of will tell you the preferred option. And that's because a number of actuaries, most actuaries operating in this industry got together and we all agreed we actually can't recommend the preferred option because we don't have all the information that we would need to do so. And it would be unprofessional in order to give you that recommendation. So none of us are able to do that. So one of your options is to perform the calculation using one method, see what the tax return looks like, perform the calculation using another method, see what the tax return looks like, and then you can decide what is the better option. You'll need to get 2 versions of the actuarial certificate in order to do that. And Lime Actuarial gives you unlimited versions, so that shouldn't be a problem. So that is an option for you, is to run the calculations twice. I've come up with a bit of a rule of thumb. If the income's earned evenly throughout the year, mathematically, as I said earlier, it doesn't matter which method you use. I prefer the proportionate method. I find it more intuitive. I think most of you do as well. If you have any large capital losses, then the proportionate method will ensure that those capital losses get retained. And if the income is front-ended or back-ended, what you want to do is you want to align the time of when most income is earned with how you can achieve the higher ECPI percentage. And that's really looking at the same examples that we saw a few minutes ago. So there's some rules of thumb for you. If you have any questions and you're not sure, feel free to call me and happy to talk through the scenario with you. So that wraps up that section. I'm now going to turn to the Q&A. We've had quite a few questions that have come in, so let's go through those. Okay, next question. You have a fund in pension mode and they receive a contribution. The accumulation account is converted the following day after receiving the contribution. Do you need an actuarial certificate for that one day? So first of all, you don't have to wait till the next day. You can you can start your pension on the same day as the contribution is received. And the ATO has said that if the contribution comes in and the pension is started immediately, then the assets can, if the assets were already segregated because there wasn't another member with an accumulation balance, then the assets will remain segregated. In which case, of course, you don't need an actuarial certificate. Now, if there is some income earned between the time of the contribution coming in and the pension starting, then you will need an actuarial certificate. So the question asked, what if the pension is started the following day? Well, by starting it the following day, you are opening up the possibility that there could be some income earned in the meantime. So I recommend that you start the pension the same day. That's not financial advice because I don't know all the circumstances, but if the circumstances permit, start the pension on the same day and then you won't need an actuarial certificate. Next question. If a member died in the previous year and we have a reversionary pension in 2024 year and have $1.9 million balance, the actuarial will not allow us to calculate ECPI. I'm just going to read that again because I'm not sure why. A member died in the previous year and we have a reversionary pension in 2024 year and have $1.9 million balance, the actuarial will not allow us to calculate ECPI. The person that asked that question, I'm not sure what's stopping the actuarial from calculating ECPI. So if you wouldn't mind providing some more context on what's stopping it, what the reason is, either by posting in the Q&A again, or alternatively, feel free to send me an email or give me a call after the session and I'd be pleased to talk it through with you. Next question, Anna. I'm doing a new client SMSFs FY 2024 tax. Aren't new clients always fun? Is it too late to start a pension on 1 July 23 as it's too late for T-bar reporting? So, really good question. So tax ruling 2013/5 says that a pension starts when the member decides to start the pension, and then that should be supported by minutes and documentation. So if you're looking at backdating the timing of the pension starting, I think it's hard to demonstrate that the member decided to start this pension all the way back on 1 July 23. Now, if you have supporting minutes that say so, then I guess that makes your position a little bit more defensible. If you did lodge a T-bar now, then you wouldn't be the first person to have ever lodged a T-bar late. So I think what I'm saying is you're not supposed to go and backdate the timing of pensions. It has been done before, but it's not what you're supposed to do. And best practice is to get your ducks lined up and to start the pension at the correct time and get all the documentation done at that time and not at a later time. Next question, Ryan, how do reserves within an SMSF impact ECPI? Reserves are treated the same way as accumulation balances, so they reduce the ECPI. Next question, I'm an accountant, Vicky, work with various financial planners who sometimes want to commence pension accounts within a financial year rather than on the 1st of July or the end of the financial year, the 30th of June. As an accountant, I prefer to calculate at the beginning or the end of the year, which makes it easier and cleaner to process. If it happens within a financial year, we need to do twice the processing, one for commencing of a pension and one for the end of the financial year. It's double time. And sometimes the annual tax statement and documents won't be produced before October. How to cope with this work? Also, if you need to order an actuarial certificate, do you need an actuarial certificate in the middle of the year? So there's two questions there. Vicky, there's a trade-off here between doing a little bit of extra work and getting a better outcome for your client, or doing a bit less work and getting an outcome for your client that's not quite as good. I guess that's a business proposition question for you. If you are out there as putting yourself out there as a professional, trying to do the best thing for your client, and you want to get the maximum ECPI for them, then you achieve that by starting a pension as soon as you can, and which might be in the middle of the financial year. If that creates a bit more work for you, then maybe you need to charge a little bit more for that. But that's what's going to give the best outcome to the client. And you have to make that trade-off for yourself about what your value proposition is to your clients and how you charge them for that. Do you need an actuarial certificate in the middle of a year? Not only do you not need one, actuaries are actually not permitted to give you an actuarial certificate for the middle of the year. However, we can give you an estimate of the ECPI, and we've actually just introduced a new feature on our website, a self-service feature, to allow you to get that estimate, and then you can take the estimate and plug it into your accounting software to calculate the most accurate balance at a point in time. Vanessa, can you explain the impact or implication if it is a disregarded small fund asset issue for a member in the fund? For example, if a member has two funds, one 100% in pensions and the other fund only has accumulation balances. So if the member has met those two criteria, they have a balance of more than $1.6 million at the previous 30th of June, and they had a pension balance in a superannuation fund, in any superannuation fund, then the assets will be disregarded small fund assets for all funds in which that individual is a member. When you say income, do you mean net income? I think you're referring to income in relation to ECPI. So I'm specifically referring to the investment income, less any expenses that might directly, depending which method you're using for tax deductions. But I think you should assume we're specifically referring to investment income for the fund. Next question, when using the segregated method, do we need separate asset holdings for the accumulation and ECPI accounts? E.g., can we have a single holding 1,000 BHP shares, 700 accumulation members and 300 ECPI members? So what you're referring to there, Daniel, is called segregation by election. So yes, you can do that, having separate assets for accumulation members and separate assets for pension members, for account-based pension members. You can do that. I find that segregation by election can get very difficult, and there's just a lot of nuances that are difficult to get right. So I don't like segregation by election. What I've been referring to is called deemed segregation, which is not having separate accounts for pension and accumulation balances. It's just saying that when all the balances are in pension, the assets are segregated. At other times, the assets are considered to be unsegregated, and that's deemed. You have no choice whatsoever. Okay, next question. Considering that this fourth option gives a tax advantage, has there been any case law to establish that the ATO will not allow Part 4A for avoiding tax? Danny, I'm sorry, I'm not sure which example or which screen you were referring to there. So if you wouldn't mind just elaborating on that, that would be great. Now, I am conscious that we've got quite a bit to get through still. So what I'm going to do is I'm going to pause there. I'm going to keep going with the presentation, and I'm going to come back to the rest of the questions at the end so that we can at the very least get through the presentation. And as I said, I'm going to stay on here for as long as I need to in order to answer all of the questions. So now we're looking at more complex examples during the year. So these are decisions you'll make during the year, which are more complex than the ones we saw at the beginning. We're going to start off looking at this scenario of selling an asset. So here we have two members. Member one has a smaller account-based pension account. Member two has a larger account, starts in accumulation, then it goes into full pension, and then some more accumulation is added on top. So another contribution comes in. So if we use the proportionate method here, we say, what's the ECPI? It's the dark blue divided by the total. It's perhaps around 40% or thereabouts. That's the proportionate method. That's what you would see on the actuarial certificate if we use that method. Let's look at the segregation here. We start off for the first, looks like about 7 or 8 months. The assets are unsegregated. And then we have a period where the assets are segregated. And then we have another period where the assets are unsegregated. So if we use the segregated method, what you see on the actuarial certificate will be one blended percentage of the first period and the third period. So it's going to be lower than what we saw before, perhaps only about 30% this time. So we're selling an asset, and what we want to try and do is sell it during the period where we can maximize ECPI. So clearly that is going to be in this segregated period between about months 8 and 10. So if we can sell the asset in that period, all the capital gains are going to be 100% tax exempt. That's the ideal outcome that we're aiming for. If the asset had to be sold, let's say at the beginning of the year for some reason, then you'd want to use the proportionate method. If you use the segregated method, you're only going to get a maybe 30% ECPI in that period. So we want to try and use the proportionate method if we're going to sell the asset early. Now I see this scenario arising a lot, and it's all going along very smoothly. The planning's all done well. We know that we're going to sell this asset towards the end of the year, and the assets are going to be segregated. I want you to pretend that that accumulation balance at the end, that small accumulation balance, wasn't there. It's all going along smoothly. And we've decided that in June, we're going to sell this asset. The balances are all segregated. And suddenly, without warning, a contribution comes in. It might be an employer contribution that you weren't expecting. It might be a government co-contribution that you weren't expecting. It might be that the member just decided to put some money into the super fund for some reason. But that's really going to mess up your plans. So you have to be really careful if you're trying to sell an asset when the existing assets are segregated, you have to be really, really careful not to put in another contribution that's going to mess things up. And I can't stress that enough because I see this situation arise so often. Here's another scenario. We have two members in this fund. Member one is in accumulation at the start of the year and pension at the end of the year. Member two has a small accumulation balance. And you know you're going to sell an asset towards the end of the year. How are we going to plan for this in order to get 100% of the capital gains being tax exempt? Well, of course, if we can move member two into account-based pension, then that's going to solve the problem. But you might not be able to because they might not have met a condition of release yet. Or perhaps it could be that member two has already either in this fund has a pension balance and an accumulation balance, or perhaps have a pension balance in another fund, and they've met their transfer balance cap. They can't put any more into pension. So what are we going to do with member two? Well, if you have some good planning in advance, you may be able to get member two out of the fund, so there's only member one. But I am going to warn you on this. You don't want the tax office to look at this and say it's tax avoidance. And I think that if you just transferred member two out of the fund and then very shortly afterwards you sold the asset, the ATO may well look at this scenario and say that's tax avoidance. So if you wanted to try and achieve that outcome, you're going to have to plan for this well in advance. Perhaps move member two out in one particular year and then sell the asset in the following financial year or something along those lines, or have a really good reason for moving member two out of the fund, which is not a tax-related reason. Now we're going to look at the scenario of the transfer balance cap increasing. So what we have here is we're looking over 2 years. We're starting at July 24 and we're going to June 26. You'll see the thick dotted line, the vertical dotted line in the middle is the new financial year, and the slightly thinner dotted line at March 25, that's where we are now. Okay, and your client has come to you and said, I'm thinking of starting an account-based pension for $1.9 million. I've got $2.5 million in my accumulation balance right now. I want to start a pension for $1.9 million, which is the current transfer balance cap. Should I be starting that pension now, or should I wait until the 1st of July when the transfer balance cap will have increased to $2 million and I'll have a larger pension forever? So what's better, to have $1.9 million in pension starting now, 3 months earlier, roughly, and then having that $1.9 million forever, or waiting 3 months and having $2 million in pension forever, of course, subject to drawdowns and investment earnings. So that's what I'm going to analyse now. I did say there won't be a lot of numbers today. There will be for this particular scenario, but they're not difficult numbers to get your head around. So this is a comparison of the two options. The one on the top is the dark rectangle is further across to the left. And the one at the bottom, the dark rectangle starts later, but it's higher. It's a $2 million balance rather than a $1.9 million balance. And then that goes on indefinitely. Which is better? I won't run a poll. I'll share my calculations with you. So if we start the pension on the 31st of March, let's suppose you walk out of today's webinar and you think I better do this with my client. I'm going to start this pension on the 31st of March. The ECPI calculation for the current year would be 1.9 divided by 2.5. That's the proportion that's in account-based pension for 3 months of the year, for 3 out of 12 months. And that works out to be 19%. So you'd have 19% ECPI using the proportionate method. And then if we look at the future years, so the calculation for next year will be 1.9 divided by 2.5. Won't be exactly that because the pension balance will have gone up by a little bit less than the accumulation balance due to drawdowns, but it's pretty close to that. And that works out to be 76%. So we can have 19% this year and 76% next year and in future years. That's what we'll get if we start the pension on the 31st of March. If we start the pension on the 1st of July, you can run through the calculations that are there. We're going to have 0% ECPI this year because we're not starting the pension this year. And we're going to get 2 million out of 2.5 million, which is 80% ECPI in 25-26, and then in future years as well. So we have this trade-off of, by delaying the pension, we sacrifice 19% this year and we get 4% every year in the future. So this is like an investment that goes into perpetuity almost, of putting in, let's say, $19,000 and getting a return of $4,000 a year forever. Is that a good investment? I think it is. You're getting a return of, give or take, 20% per annum. I think that's a good return, effectively tax-free. So I would forego the 19% this year. I'd wait until the 1st of July and take the extra 4% ECPI next year and into the future. So the message there is, if you haven't started a pension yet, then try and delay it until the 1st of July 2025. That's if you haven't started a pension yet. But what if you already have started a pension in the current year? What if you started your pension back on the 1st of July 24, which I'm sure many of your clients have done? So that's what this comparison looks like. The top one is starting the pension in July 24, and you'd have a balance of $1.9 million, both in the current year and in future years. And the second option is pension balance of $2 million starting on the 1st of July 25. So we're going to have 76% ECPI in 24-25, and then in future years again. As I said, it's not exactly 76 in future years because the accumulation balance will grow faster than the pension balance due to the drawdowns, but it's a reasonable approximation, especially in the earlier years. And alternatively, we could have 0 ECPI this year and 80% ECPI in the following years. So this year, this time you'd be getting, by delaying, you'd be getting a 19-year payback period or only about a 5% return or thereabouts. I'd be inclined to start the pension earlier here, start the pension on the 1st of July 24. Now, of course, it's too late to make this decision because if you were starting the pension on the 1st of July 24, you should already have done so. You should already have signed the pension minutes, lodged the T-bar, and so on. If you had started a pension then, and you wanted to get out of it in theory, the way to do it is not to meet your minimum pension withdrawals. Just as an aside, because if you don't draw down on your pension, the pension is deemed to have ceased back at the beginning of the year on the 1st of July 24. But I think in this case, you do want to keep the pension going. And so you should make your pension drawdowns and take advantage of getting that higher ECPI, the 76% ECPI in the current financial year. So the message there is keep your pensions if you already started them on the 1st of July 24. Okay, this last series of examples is going to be the last set of examples, and then we'll move into the Q&A. So here we have a scenario. We have a pension balance of $1.8 million. The member, let's suppose, has already used up their entire transfer balance cap. We've got an accumulation balance of $200,000. The minimum drawdown for this member is $90,000. Their actual drawdown is $180,000. We had a question about this earlier and I said I would come back to it. I'm now coming back to it. So I'll come back to it in this example, 8A and also 8B. So the actual drawdown is $180,000 and there were 4 drawdowns, the end of September, the end of December, the end of March and the end of June. And what I see a lot of accountants doing here is just taking each of those $45,000 payments out of pension. You can trust me that the ECPI this year would be 89.4%, and then it will be a little bit less next year, and in future years it'll be 89%. If nothing else changes, apart from just taking the drawdowns on this pension. What I'm going to encourage you to do, though, is instead of taking those second 2 payments out of pension, why don't we take them out of accumulation? Reduce the accumulation balance, and that's going to keep your ECPI higher. Instead of getting 89.4% ECPI this year, we're going to get 91.2% because we're keeping more in pension. And next year, we'll get 94%. We'll get an extra 5% ECPI next year by taking those payments out of accumulation. So I do see quite a lot of accountants doing this. I'd like to see everybody, I've only presented 2 options so far. I'd like to see everybody doing the second option as opposed to the first. I can't see any really good reasons to go with the first one. But I'm going to show you a third method I don't think many of you are doing. And I know this because I see lots of data coming through. I see lots of data in our actuarial certificates, which shows me that not many of you are doing the option that I'm about to show you. And that is, flip it around, take the first 2 from accumulation and the last ones from pension. Because that way we're keeping the pension balance as high as possible during the year. For future years, we're still going to get 94%, but we're getting an extra 2.4% in the current year by getting the accumulation balance down early and keeping the pension balance as high as possible. So I hope you can follow what's happening there. So the message there is withdraw the excess from accumulation and withdraw it early as well if there's an excess. Keep the pension balance as high as you can for as long as you can. Now, this is the same example, except there's no accumulation balance. So this time, we have an excess. We have to take it out of pension. There's nowhere else for it to come from. We only have a pension balance for this member. What most accountants, or what many accountants are doing is taking this as a pension drawdown. What you could be doing is taking the excess as a commutation. In other words, you commute the payment from pension back to accumulation, and then you take it out of accumulation. It's not improving your ECPI. Your ECPI is 100% anyway here because you've only got a pension balance. But what it is doing is it's giving you transfer balance headspace so that if you need some more transfer balance cap in the future, you will have some. Why might you need it in the future? Because you don't have any accumulation balance. Well, this member might receive a reversionary pension, or maybe they'll be able to make some more contributions in the future. Maybe their balance will fall below the transfer balance cap, so they'll be able to make some more non-concessional contributions. Or maybe they'll start working again and they'll be able to make some concessional contributions. It could be a downsizer contribution. Whatever the case is, they might have an opportunity to make some more contributions in the future and then get some more balance into pension. So I'm going to finish the presentation there. The message is, if there's any excess, commute it if there's no accumulation. I'm going to finish there and we're going to move into Q&A. For those of you that need to leave now, thank you very much. But I'd encourage all of you to stay on. There are plenty of questions, which is great to see so much interest. I think we've got 28 questions, some of which I've answered already, and I'm sure there'll be more coming on. So I'm going to keep rolling through those questions. For those of you that have to leave, as I said, thank you very much and really appreciate you attending today. Thanks for your support, not only today, but always. And for those of you that aren't clients, hopefully we'll get an opportunity to work together in the future. And I'm just going to keep answering questions. I will be sending a recording in about a week's time. I'll keep answering questions now until the questions run out. I've got plenty of time. So let's get into those questions. Okay, Chris asked the question, can we change the method in different financial years? He's asking, can we change the method between the proportionate and segregated method? Yes, you can, and you're encouraged to change the method in different financial years. The ATO has said there's no issue with changing the method. That's not considered to be tax avoidance. If you do change the method, the default method is considered to be using the segregated method during the periods where the assets are segregated. So if you do want to use the proportionate method, your clients do need to sign a minute saying we've chosen to use the proportionate method for this year. Next question. If a client sold a property in the middle of the year, we would normally recommend to them to start the pension at the beginning of the year to get the CGT exempt. Good idea. If the pension starts in April, right before they sold the property, will they still get full exemption for the CGT? I think this question was asked before I presented the section called after year end. It depends whether you're using the segregated or the proportionate method. If you are using the segregated method and all of the assets are segregated, so all the balances are in pension and there's no disregarded small fund assets at the time of the property sale, then yes, the CGT will be 100% tax exempt. If you're using the proportionate method, then there will be some tax payable. How is the profit allocation done for members? I'm not sure if you're referring to a specific example, but as a general rule, the profit should be allocated on a fair and reasonable basis between the different members. For example, in relation to the average balances throughout the year, that would be a reasonable method of allocating profit between the members. Okay, next question. We've received a contribution in the month of June. I will not apply for an actuarial. Is this okay? Or can we claim ECPI? If you want to claim ECPI, you will need to get an actuarial certificate for this scenario of where you've got a contribution in the month of June. That's black and white. Even if it was only a $1 contribution on the 30th of June, if you're using the proportionate method. Now, if you're using the segregated method, you might say, well, what we're going to do is we're going to claim ECPI for the first 364 days of the year. We don't need an actuarial certificate for that because the assets are segregated. And on the 365th day, well, it's only one day, so we just won't claim any ECPI for that day. If you do that, then no, you won't need an actuarial certificate, but you're missing out on ECPI for that one day or for however many days there were where the assets were unsegregated. And often the income on the 30th of June is more than on any other day of the year because you get trusts distributing on the 30th of June. So in most cases, you'll benefit from getting an actuarial certificate, but you're not forced to use one. You just can't claim any ECPI for the period of unsegregation. Next question. Member died during the year. How to calculate the correct death benefit without the actuarial percentage? So I think what you're saying here is you want to know an interim percentage. So if ever there's a time in the year, whether it's starting a pension or whether it's a death benefit, and you need an estimate of the percentage, then your accounting software will give you a reasonable estimate. And in most cases, you can rely on that. But if you're not sure, then start an actuarial request. And once we've got all the data, once you get to a step where Lime Actuarial has the data, just send me an email and ask for an interim percentage and I'll be able to help you with that. If you're not sure about that, just feel free to send me an email afterwards. Okay, Vanessa is asking a follow-up question. So Vanessa's first question was, can you explain the impact or implication if it is a disregarded small fund asset issued for a member of the fund? For example, we have two funds, one's 100% pension in place and the other one only has accumulation balances, and then do we need to get an actuary certificate for the pension fund? Okay. No, if the balances in the fund, so Vanessa's question was, we've got two different funds, the members have pension in one and accumulation in the other, and there's disregarded small fund assets. Do you need an actuarial certificate for the pension fund? No, you don't. You used to. There used to be a time when you did. You don't anymore. There certainly was a belief at one point in time that if you deliberately created a scenario of having all of your members' accumulation balances in one fund and pension balances in another fund, that might be Part 4A. And there were some scenarios where the ATO did consider it was tax avoidance, but not every scenario. So just satisfy yourself that you're okay with Part 4A there. But no, you won't need an actuarial certificate for that scenario. Incidentally, if you have, let's say, a member with $3 million, $2 million in pension, $1 million in accumulation, the assets are unsegregated. And if you have a fund with $3 million, all in pension, now that might be they started with $1.9 million and had some really good investment earnings, grew it to $3 million. The balances are all in pension. The balances are technically unsegregated because the assets are disregarded small fund assets. You don't need an actuarial certificate in that case either. Next question. Is there a best practice for deduction percentage, i.e. use actuarial or ATO formula? So there's two different methods of calculating deductions for expenses. You can use the percentage on the actuarial certificate or you can use the ATO statutory formula. Is there best practice? No, it depends on the scenario. Your accounting software will calculate the deduction based on the preference that you've put in, and that can vary from fund to fund. I wouldn't say there's any particular best practice. It depends on the particular scenario. Okay, next question. Vicky, further my question. If commence pension in the middle of the year, the T-bar report also need to concern and lodge. The T-bar report is quarterly due to date now. Is there any penalty or charge so far in real life by the ATO? So I think Vicky is asking, is the OTO charging penalties for late lodgement of T-bars? Not that I'm aware of. I'm not a tax agent. I don't have to lodge any T-bars. And so if they did start penalising for lodgement of T-bars, I may be the last one to find out about it, together with the other actuaries. So don't take my word for it, but as far as I'm aware, I haven't heard of any cases where they have penalised for late lodgement of T-bars. I think if they were going to, they would probably put out some kind of industry letter to practitioners warning everybody, because there are so many T-bars that get lodged late. They put out a warning, I think, before they started penalising, but I can't promise. So I think the best answer is just get your T-bars in on time and don't backdate pensions. Vanessa is asking another follow-up question. Is there any ECPI impact to the pension fund by virtue of the DSFA implication? No, there's not. So the ECPI would still be 100% for that pension fund. Danny, I was referring to the option of when the income is received at the end of the year, when the fund was in full pension, and the ECPI was calculated on as segregated, even though the fund had an accumulation during the year. Okay. And this is a follow-on from Danny's earlier question. Considering that this fourth option gives a tax advantage, has there been any case laws to establish that the ATO will not apply Part 4A? Oh, so this is choosing whether to use the segregated or the proportionate method. Is that considered Part 4A? No, it's not. The ATO is very clear on this, that you can choose which one you use and that you can make that choice after the end of the financial year. And that's written in the explanatory memorandum when that legislation was introduced as well. So you are permitted and you're encouraged to make that choice as to which method you use. Would it be more optimal to start a pension in March for $1.8 million and start another pension in July after the indexation has been applied? Okay, so the current transfer balance cap is $1.9 million. And the way that the transfer balance cap works is if you start a pension now for $1.9 million, you have used 100% of your transfer balance cap. You cannot use any more. Even if the balance goes up, you still cannot use any more because you have used 100%. If you started only $1.8 million pension now, you have used 18/19 of your transfer balance cap, and you still have 1/19 left that you could use after the 30th of June or at any particular point in time in the future. But based on that example that I presented, I believe you would be better off waiting until after the 30th of June. Got a comment. Wow, that's a great idea. Thank you for the feedback. I'm not sure which idea it was, but thank you for the feedback anyway. Excess drawdowns. Question from Pete. What if the client's bank statements state pension payment for each of the 4 payments? Look, this is a great question. I love this question, Pete. Can 2 of these still be allocated to their accumulation account? So I know in my fund, there was a time when one of the members inadvertently put the wrong annotation on a transaction. It wasn't between pension and accumulation withdrawal. It was to do with the members. So I think it said Greg withdrawal, but we actually wanted the withdrawal to relate to Greg's wife, my wife, whose name is Kathy. And the auditor, in our case, asked us to sign a letter just stating that this was inadvertent. It should have said Kathy. It was intended to be a withdrawal, and that was the solution. Now, whether all auditors and whether the ATO accept that or not, I'm not sure, but that's what we did. But for that reason, I do prefer that when you have annotations on bank account transactions, that you're a little more vague. And so instead of saying pension payment, instead of saying pension payment for Greg, or pension payment for Kathy, or pension payment for pension number 3, or anything along those lines, if you're a bit more vague and you just say withdrawal, member withdrawal, it gives you more flexibility as to which member it relates to and whether it came out of pension or whether it came out of accumulation, and nobody's going to question it. So I like to be a bit more vague and gives you more flexibility at the end of the year. That's a personal preference. There may be others that have a different view, and perhaps with good reason, but that's the way I like to do it in my own fund. Okay, Simon has asked a follow-up question. So I just want to go back to Simon's first question, which I can't find. So Simon has said, because we have a minimum pension requirement, have to take this from the pension account. If we have an excess, can't we only withdraw from accumulation then? That's why later in the year we often commute. I think he's referring to my example 8A, where we took the accumulation balance, the accumulation withdrawals first before the pension withdrawals. There's nothing that says you have to take the pension withdrawals before the accumulation withdrawals. You just have to meet the minimum pension requirement across the year. So you can change the order of your withdrawals as long as the minimum pension withdrawals are met during the year. So when do we need an actuarial certificate is the next question. But in summary, you need an actuarial certificate when there is when there are unsegregated balances during the year, and there's income earned during that time when there are unsegregated balances, and where you want to claim ECPI in relation to that income. I think that's my summary of when you need an actuarial certificate. If you're not sure and if you have a particular scenario, feel free to get in touch with me. And I'm getting a number of thank you messages. So thanks very much for those messages. So that's the Q&A. I'm going to go to the chat box now. That was the Q&A box. I'm going to go to the chat and we'll see if there's any questions there, and then I'll come back to the Q&A again. Okay. Carol has asked, are we allowed to do this before the minimum pension has been met? That's the same question that I just answered a moment ago. So yes, you can have accumulation drawdowns before the minimum pension's met, as long as you meet the minimum pension at some point in time. Then we've got some more thank yous. And that covers off the chat. I'll go back to the Q&A. Okay, we've got another question here. May I please ask if this live webinar is recorded and if we can listen to the webinar again? Yes, I will be sending out the recording in about a week's time. So if you wouldn't mind just being patient there, I'll send it out in about a week's time. And if for whatever reason the recording hasn't recorded well, if the audio or video don't come through well, I will commit to you that I will re-record it and send it out at that time. So that's the end of the Q&As. Here we go. We've got one more from Vicky. It's often to use, is it common, I think, is your question, Vicky. Is it common to use the segregated method in the industry? Seems like more complex. Now, I think you're referring to the segregated method for calculating ECPI when you have deemed segregation. So when you can choose which method to use. Is it common? Well, it is the default method. And if you use class, you get automatically funneled in that direction. And so it becomes a bit of because it's the default method, it becomes a bit more common than, in my opinion, it should be. It's more common than it should be. If you're using BGL, then you have to make an explicit choice every time you request a certificate. So I think you would find it's used less often in BGL because you have to choose. Look, I don't like the segregated method. I believe that it can give you a better, I know it can give you a better tax outcome in some situations, and I showed you one of those situations today. I just don't like it. I don't find it intuitive. And so if the tax outcome is the same, I just prefer the proportionate method. But yeah, we get quite a lot of accountants using the segregated method, perhaps because they're using class, or perhaps because it's going to give them a better tax outcome. But I'm with you. I prefer the proportionate method. Okay, that's the end of the Q&As. I'll go back to the chat again. Okay. Thanks for a great presentation. I've only found you and glad I have. Cheers, Dave. Thank you very much, Dave. Appreciate your comments and your support. We've got lots more thank yous there. I won't read them all out individually. But yeah, once again, thanks for everybody for those comments. I think we are now out of comments and out of questions. I'm going to stay on for a couple more minutes. So if you have any more burning questions, then feel free to ask those. If there's anything you'd like to ask me privately, then feel free to do that as well. Just call up, send me an email. Our contact details are on our website, limeactuarial.com.au, and happy to take any questions or comments